So I'll try not to speak too long, even though I'm a talker. The lawyer in me says, thank you, Paul, for the SEC compliance things, just so that people understand. It's not that we're not forthcoming, but we need to make sure that we're protected and safe. But ask the questions. If we can't answer, we'll just say we can't answer. But that's so you know that we're not trying to hide the ball on anything. We're just following rules and regulations. So before I kick off, I want to say thank you, Paul. Nicole's not here, and Maggie, I think you're floating around. This is my second time here. I spoke at a meme coin event. I really love House of Web3, and we love SF and what they're doing. So thank you to everyone as well for attending. I'm a city kid. I'm from San Francisco. So when I say I love San Francisco, I truly mean it. Our daughter's from here too, and we're SF till we die, so to speak. So why am I here? What are we talking about? We're here to talk about something called the Blockchain Municipal Bond Project. There are three concepts in there. Forgive me if you know all three, but I've been doing this long enough that oftentimes people know one or two concepts, but not all three. So blockchain, that's blockchain. Most people here are probably familiar with that. In this case, we're going to talk about Stellar. There are different protocols out there: Bitcoin, Ethereum, Stellar, Ripple, Solana, Polygon, you name it. The second part of this is municipal bonds. So just a quick hands up of you. If I said treasury bill, T-bill, federal debt, raise your hand if you know what I'm talking about. That's most people. All right, that's federal debt. Municipal bonds are functionally everything below that. So your states, your school districts, your hospitals, your universities, they have special tax zones, Belarus here in California. So that's all that debt that's being issued below that. That's what we're going to talk about. And then microbonds are bonds that are low denominations. So right now, if you want to purchase most, but not all bonds, you're purchasing them at $100,000 or more, possibly $5,000 or more, depending on how they're issued. Microbonds, we're talking about possibly $25. So those are the three concepts that kind of high level kind of anchor us as we kind of talk through this a little bit. Sweet. So who am I? I always say like I'm a degen in disguise. So very briefly, I won't spend too much time on this. I teach decentralized finance law at USF. I'm the Filecoin Foundation Fellow. For those of you familiar with DeFi, basically means I teach securities law. That's essentially what it comes down to. My academic research is on NFT and IP licenses. So I do a lot of work in that space. In fact, I was working on it this morning. So if you're interested in decentralized governance, things of those issues, I'm happy to talk about that afterwards as well. This is an applied research project that we're going to talk about, and it's moving real world assets, in this case, municipal bonds, on chain. So tokenizing this debt and moving it from paper to digital on blockchain. It can be digitized already in the general sense, but we're going to put it on the blockchain specifically. My background, kind of generally how I got into this, I was a COO at a layer one startup for a while, so I've been knee deep in layer one development. So I'm familiar with kind of blockchain crypto space. I've been doing this from policy perspectives and teaching. So it's a space I love. It's a space I'm buried in, and I truly enjoy talking about it all the time with anybody. Finally, why I got into this in the very beginning, about a decade ago, although my wife usually laughs at me. I keep a card that says $25 free Bitcoin. She's like, why didn't you ever turn that in? I was like, well, 10 years ago, it was very challenging to try to do that. I should have kept it. I should have done it. But I'm a good government guy. That's my background. So openness, transparency, and accessibility are the core primitives that I see in blockchain, and that's what attracted me to this space. That's another reason I love this group. You can find me on Farcaster, LinkedIn, and things of that nature. Okay, so back to bonds. So when I talked about the municipal bond market, it's a big market. We're just talking about the United States. Bonds are global, right? The United Kingdom has bonds. They have bonds for like, cities over there. London has bonds, things like that. But we're just talking about the United States. In the United States, the market cap is $4 trillion. Anybody know what the market cap for crypto is today, roughly? 3 trillion. Okay, so just municipal bonds in the United States outpace or have a bigger market cap than the entire crypto market right now. So that tells you how big this is in potential impact. Every year, about $450 billion in bonds are issued, about 10,000 issuers. We could have more. Potentially if we change this marketplace. My whole point here is that we have a very, very big community in terms of our industry that has a lot of potential opportunities for change. Anyone know how long the municipal bond market has been around? Any guesses? Yeah, right? Forever. 200 years in the United States, plus 200 plus years. New York Canal back in like the 1820s, right? So it's been around for quite a while. The issuers, as I mentioned, oh yes, this has got the laser. States, cities, counties, school districts, universities, hospitals, housing developers. We're going to talk about housing developers today. That's what Tesla's going to talk about. School districts, actually one of the largest issuers of bonds in the country, municipal bonds, right? So you got your state of California, and then you've got like all the school districts below all issuing their own bonds. Okay, didn't work. I don't know how to, wait. It's stuck. Oh. Oh, sweet. Okay, cool. Be fast. So why is it broken? Right now, the core thing is our fixed costs. It costs about the same to issue a $3 million bond as it costs to issue a $100 million bond, right? So you can imagine the impact of that. If it costs, say, $250,000, call it 300,000 to make my numbers easy so I don't do heavy math up here. So about 10%, you're spending 10% on a $3 million bond. Now, a $100 million bond, that's no big deal. But on a $3 million bond, who pays for that? We do, taxpayers. So it's driving up the cost, right? So it prevents local funding projects like affordable housing, which is what we're going to talk about today. Because if you don't pass a certain threshold, number one, you can't afford it. And number two, they won't even take you. All the intermediaries that I'm going to talk about for a second, they'll say you're too small. So we see this cost has a massive impact on a couple of different directions. Someone once asked me, how is government in the way? And I was like, government is not in the way. It's actually the legacy infrastructure that we have from private industry. The final point, I like to note this, especially with this particular crowd. Right now, when we have a bond in San Francisco and we pay back that bond as taxpayers, where does that money go? Yeah, I mean, China, Riyadh, right? It goes outside of this country. It goes from San Francisco to Wall Street, and then from Wall Street into the world. The benefits of that is a massive liquid pool, right? It helps keeps costs down. You have more investors who could potentially come in. And so that's not a bad thing necessarily. But it also means that capital is being exported out of communities. A city like San Francisco, that's probably not as big a deal, frankly. We had a AAA rating in some ways, a AA1, another one. We're highly rated, very sophisticated system. And we're a very wealthy city, so we can afford that. But if you can think about smaller communities, remember I said school districts, hospitals, universities, that money now is going from those local communities right out of the country. Okay, so why does this matter in terms of size? We know that we have this big market. 65% of all issuances are less than 25 million. Remember those fixed costs? Small bonds, big money. So most of the issuances are actually by smaller bond issuers. So they're paying higher interest rates. So that money's being pulled out of the country. And that impacts housing, tribal communities. They go through this process, school districts. So this hits you, whether you know this or not. This is touching you every day. So by and large, most communities, okay. So the question was, well, how's the money being pulled out of the communities? So what happens right now is if the city of San Francisco, for example, wants to issue a bond, they take that bond issuance to the national market. They don't do it locally. They don't fund it locally. And when that happens, they take that to Wall Street, basically. It's bankers that take that and they syndicate it. So they issue the bond, the bankers buy the bond, and then they push it out into the secondary market. When it goes into that secondary market, it's open to anybody to purchase at that point. By and large, if you're issuing, and I think we have about $2 billion in bonds in San Francisco, we locally are not purchasing those $2 billion in bonds. We're selling them into the national market, so anybody can buy them. Once they're purchased, we pay those bonds back, right? The city of San Francisco has to pay those bonds via you and I, taxpayers. Right, so we make payments semi-annually in this case, and those payments go to whomever owns those bonds. The highest probability is that the owner of that bond is not located here in San Francisco. By and large, they're going to be spread out throughout the country, and they're going to be outside of the country as well. So when I say we're exporting money out of local communities, what's happening is that taxpayers, and I said San Francisco, but imagine a $5 million bond in Vallejo, right? When they take it to that national market, they're paying back the investors, and those investors are spread out throughout the country and throughout the world. So those tax dollars are going from Vallejo out to wherever the investor is. Does that make sense? They got the money, and taxpayers are paying the money out, right? So you're paying an interest rate on that as well, because you have to pay back the bond plus the interest. So you're paying back the bond, plus the interest. So that's money that isn't staying local. That interest is going outside. You have a question? No. The reason the large pools work is because it provides that access. Yeah. Oh, it varies on a variety of factors. It varies on what the current interest rates are, right? It's similar to a mortgage, but it's a bond, not equity, right? So with mortgage, you're paying off the debt and you have ownership over the property. With a bond, you don't have equity, you don't have ownership, you're just paying back debt. So if you borrow, whatever, $1 million and you pay 10% interest, you have to pay back the $1 million plus the 10% interest, whatever your interest rate is. 20. Mhm. I mean, I just picked a number, but you can calculate that out. If you're paying 10% on a $1 million bond, so 100,000 times 20. Possibly could. I mean, oftentimes they do reissuances and things like that, but yeah, that's the money that's coming from the local community out, right? The benefit, though, is the exact opposite, which is, hey, we are able to access a national or international pool of funding so we can drive our interest rates down. Right? This isn't a good versus evil story. This is hey, this is a capital stack story, and who's paying for that and where they're paying for it, and how can we crush those interest rates down as much as possible for you and me as taxpayers and for local entities. Because I'll give it correct to you. Because, right, the less interest we pay on any debt, where does that money go? Back into the community, right? Because it's coming out of either a general obligation bond, possibly a revenue bond, which in this case, it might be okay. The question was whether bonds perform like stocks.
Right.
They are bought and sold and traded, yeah, depending on interest rates. And there are millions of types of financial products that can emerge from that as well. Fluctuate? Yeah, they can fluctuate. Yeah, the same bond can be traded, so it can fluctuate in terms of pricing. But regardless, right, if the government entity has to pay it, right? So it could be traded below par, we call below par or above par, but it has to be traded or has to be paid, excuse me. Yes. And demand is dictated by a variety of factors. Sorry, Paul, I see. You want me to keep going? I'll be quick. Okay. I like the questions though. Like, we'll keep them and we'll do them in the conversation. Are you editing again? I can't. It's stuck again. Yeah. I was almost there. All right. Okay, there we go. It's coming, I think. It shows up here, but not there. That's fine. Oh, anyways, what I had is another slide. I'll just walk you through it very briefly. All right, okay. Reduce the cost of capital credit, increase government financial transparency, invest in local communities, build community resilience. What I was going to show you next, it's unfortunate that I can't, is basically how we're breaking down the intermediary aspect of this as a visual. And it shows kind of what the current structure is: bond issuance, intermediaries, investors. And the other piece of that was a bond issuance, blockchain investors. And the two big differences that you would see, there would be two big differences. Number one is you'd see the intermediaries kind of get crushed. We can talk more about that in the conversation. The second thing that you would see is that the investor pool goes from having a primary and secondary to just one. That matters because secondary buyers pay more than primary buyers. Who's a primary buyer? Banks. Who's a secondary buyer? Us. Wrapping it up, in terms of the project, this was the last one, it didn't show up. In terms of the way the project is being run, we are working on issuing a blueprint for how municipal bonds can be issued on blockchain. The blueprint will be open source. So any entity could take it, any entity can build on it for any type of protocol. We are working with a variety of partners. One is Stellar, which is a protocol here based in San Francisco. They are the grantor, we are the grantee. And that's the protocol that we are using. Another partner is Tesla, whom I'll let him talk about his project because I don't want to take his thunder. He does it so well. Other partners include financial technology company called Blocktime, which is building the tool to tokenize the actual bond itself. For those of you who have any technical questions about how this actually happens, how you go from A to B. And then we're working with Squire Patton Boggs, a law firm, which is providing the legal, pro bono legal advice and guidance for this process. And that was it I had. I was going to say, last thing was you could, here's the visual. You could find me on LinkedIn, Farcaster, or the USF website if you have questions, charlesbell.xyz. So the question was whether we're being pegged, the bonds being pegged to the US dollar, and the answer is yes. Denominated. Yes, sorry, denominated, yes. It's still, because these are still US municipal bonds, so, we're not going to adjust that. Now,
Speculation was a cryptocurrency.
there's no what?
Speculation based on the pegging and solidity of a cryptocurrency.
Correct. The underlying, the purchase can be done through USDC, or theoretically you could purchase it through Bitcoin, but the way it will be denominated, the bond itself, will be in US dollars. From there, you can do things with it.
And a follow-up to an earlier, you mentioned the speculative bubble of cryptocurrencies is 3 trillion. How much money actually went into that, as opposed to the current presumed value of it?
That's a fair question. Like, you mean like the value of Bitcoin is $1, so to speak, but actually only 10 cents has been put into it? Like, is that what you mean? Like, for example, Bitcoin may be worth $1, whatever, but only 10 cents was actually put in, people, right? Yeah, that I can't tell you. In this case, we know very clearly like what the amounts are, what the numbers are. I mean, it's the bonds, right? It's government accountability, accounting system, GAAP accounting, it's pretty standardized. So the thing that I'll close on this, because I know Paul wants to give opinion, is I think about this as my work is around real world assets moving on chain, right? And so for those of you that like, I don't get crypto, crypto's like a scam, and so I don't get it. We're talking about real world assets here. We're talking about things that you know and use or rely upon in some way. So they have actual dollars behind it, or euros, or, or what have you, pounds. And that's the big deal. Our change here in this project that we're going to talk about today is about how do we eliminate the intermediaries? How do we get rid of the middle part that's driving up the fixed costs for everybody? It's not about saying we're going to fundamentally change the monetary system, right? It's about really making this more efficient. And that efficiency in this case is actually making the cost of capital cheaper for everyone.
Perfect. So I think your slides are working. This is great. So we're going to take a couple of questions. And I guess you're going to run 2 mics here, Maggie, because I'm going to reboot the presentation and I'll work in the background.
That was the visual.
Okay, do you want to describe the visual?
Can I go ahead?
Go ahead, sorry.
Yeah, so it's a great solution, it sounds like, but the intermediaries are performing functions that are important for getting the bonds out. And I'm just wondering, if you digitize that and you disintermediate that process, are there loss of functions that the blockchain capability cannot account for or substitute rightly for actual people who were at one point doing that work? So it's not just that you're getting rid of the intermediaries, but those people were there. Are there things that the blockchain, if you get the people out, the intermediaries out, that whole process would not be as efficient? Because that rate is that they're paying for their services. It's not just that they're taking money and running and sitting around. They're actually performing functions that are important for that sale.
Can I give you the law school answer?
Yes.
It depends. As my professor answered everything to students, it depends. So yes, I'm gonna say yes and no. Actually, no, let me take a step back, TBD. So part of this project is identifying what those intermediaries are, and then identifying whether we can actually solve for them in a more efficient way. So in that sense, I think your question is right on point. It's part of the work that we're doing, and our final report will include answers to that. Maybe not that explicit way, but it will talk to those points that you asked about. The roles that we see, these intermediaries that we see, are important. They're important only because the market demands them. And for any lawyers in the room, it's just me. Okay, any other lawyer? Okay, great. A lot of it's just for what we say CYA. A lot of it's liability. I have a slide for every class where I'm like, remember the stakeholders. Crypto can be crazy, but remember who's going to get sued here. That's what a lot of the infrastructure is about. People are trying to have arm's length distance, reasonably so, for liability purposes. What we have found is 2 things, 2 sides of the same coin, actually. On one hand, they're very needed. A lot of those services are very, very needed. I'll give you a good example is credit ratings. Credit ratings allow investors to quickly identify what they can invest in, or if they have to sell because they have a certain type of fund that says it has to be AAA, nothing lower, things of that nature. I think that's what you're talking to. The flip side of that, however, is it means now these ratings folks have a gate that has to be passed. And they have financial incentives as well as to whether they will pass along a bond or not. So what we're trying to do is kind of, I'll say, thread that needle. On one hand, we know that we cannot get rid of ratings. If we get rid of ratings, what we're trying to do will not work. It just won't work. So we have to solve for that. But at the same time, we are trying to get rid of this whole gatekeeping, where a group that doesn't care about the bond, right? And they have fine financial incentives. It's not a good versus evil story. But they're gatekeeping and saying, we're not even going to look at bonds below this level. And once they don't look at that, they become high yield bonds, AKA junk bonds. What happens when you get called a junk bond? Interest rates go up, right? It's harder to issue. So it's threading the needle between those two pieces of saying, how can we still provide the credit ratings, as this is one example of many, how can we still provide the credit ratings that are needed for the marketplace, while at the same time, how can we open that door that they're now gatekeeping? And not gatekeeping again because they're bad, just because of the structure that they have, the incentives that they have. Because it costs money, that's those fixed costs. It costs money to rate. And if you don't rate it, I'll say, well, or your materials, you have material emissions, or you miss things, you get what? Sued. So this is all happening behind the scenes. Every time a bond is issued, we're having these intermediaries come in, and a lot of times what they're doing, you'd be surprised how many lawyers are in the room from all sides, checking things off, signing things off to make sure that the liability, their client doesn't carry that liability. So that's the thread, the needle that we're trying to thread. But it's a great question.